John, as we approach the end of the second quarter, what can we make of the global economic situation at the moment?
Well, Danielle, there are a lot of mixed signals at the moment. In the overall sense, the major GFC-affected economies like Germany, France and the US have all got back into strong recovery. But we're getting issues like sovereign debt problems with smaller companies in the Eurozone like Greece, Portugal, Ireland and Spain. And it's sort of working out the problems of post-GFC, although many of these problems have been inherent issues with those economies. Just recently we've heard announcements coming out of Greece where the EU and the IMF have put together a second tranche financial package for the long-term recovery of the Greek economy. And the Greek government have introduced legislation that will take measures to correct their long-term financial future, including the sale of some of their major assets like their telecommunications utility and the reduction in overall spending going forward. So that's good news, and we'll see more of that going forward. These aren't short-term issues that can be fixed overnight. They're long-term issues with long-term social ramifications, and there's no quick fix because it would be too much of a shock to the community. So whilst it's been bad news, it's getting better, and as these things work through, the global economy will strengthen. The powerhouse growth economies such as Asia and Latin America have continued their strong growth, and that doesn't look like slowing down anytime soon.
Are there indicators to suggest that we'll see a recovery in the US anytime soon?
Well, the US has really been back into fairly strong economic growth over the past couple of years. The two indicators that are holding it back are unemployment and manufacturing, where some figures have come out to show that those areas are being slowed down. But we've got to bear in mind that America is still the biggest economy in the world, and whilst their unemployment is sitting at 9%, that means they've got 91% fully employed. So it's not all bad news. And I think we also need to appreciate that the American stock market had recovered to within 10% of its all-time high. So it wasn't unexpected that there might be a bit of overreaction to these recent economic indicators.
Last quarter, Australia's economy suffered its biggest quarterly contraction since the recession of the early 90s, largely due to the impact of the floods in Queensland. How's the Australian economy faring at the moment?
The Australian economy is tracking pretty well. This negative GDP figure for the first quarter was fully expected, and we touched on this in our last update that there were going to be ramifications from the Queensland floods and the cyclones, and that certainly occurred. The major impact was the reduction in coal production and primary produce. So not unexpected, has been a gross overreaction by the media, but we think that we expect that the Australian economy will get back into positive territory in the second quarter. It's interesting that both the government and the Reserve Bank have predicted growth rates for the Australian GDP of 4.3% in the 2011 calendar year and 4.25% in the 2012 calendar year. Very healthy figures for us, and we see that the Australian economy is in pretty good shape.
Are we at all impacted by the global instability happening around us?
We are, because we tend to react, and we react certainly to the American market, and that has reacted in turn to bad news coming out of Europe. So we're a reactive market at the moment, and it's all pretty unsettling. And I guess that's the issue, that in Australia we have a lot of uncertainty. People are concerned about the unknowns of the mining tax and the carbon tax, what that'll mean to their rising cost of living, the possible threat to jobs, etc., 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 which none of us really know until the government give us all the information regarding the tax itself and the offsets. But it's just unsettling. And of course, the fact that we've got a pretty unstable government, in that we've got a minority government, and both sides of Parliament are just throwing stones at each other. And I think that's also very unsettling to the Australian public, that we really want to see stable government looking after our interests and making good policy.
John, it's fair to say investors have had a rough time extracting value out of the market recently. Where are the hotspots that you're watching at the moment?
Yes, it's certainly been a hard slog over the past 3 years, and investors have found it difficult, again, to get some confidence in the markets. I mean, we did have a very strong recovery in the Australian stock market in 2009, about 34%, which went a long way to getting value back for investors. But since then, it's been very flat, although all of the so-called experts, including ourselves, expected the Australian market to recover much stronger than it did last year and this year. And it's really the only contributing factor is uncertainty. If you look at the fundamentals of the market, it's very, very strong. Dividends are improving, company profits are improving. In terms of hotspots, the residential property market is coming off. In the inner suburbs, it's come off 10 to 15% and probably likely to decline. If we see interest rates increase, then that'll have a further softening impact on residential property market. So we think the market will certainly flatten and maybe present opportunities. But on the other side of that ledger is the high demand. There's still a lot of high demand for property, and that'll tend to keep the market up. In the commercial property space, we see opportunity. That area of the market has been flat for the last 2 years, but we see as the economy strengthens, there'll be a strengthening in the commercial property market. So we're certainly looking for opportunity there. On the global equity market, the issue has been, even though global economies have recovered, so has the Australian dollar, so that returns from the international equity market have been kept down by the strength of our dollar. And whilst our dollar's good for travel and buying flat screen TVs, it's not too good for people investing in Australia when they see the long-term average value of the Australian dollar at around 80 cents against the US, so that an investor overseas can be concerned about an exchange loss if they invest in Australia. This is a new paradigm. People will get used to the Australian dollar being better than parity with the US, so that we'll see investment start to, and we have in fact seen investment start to increase in the Australian markets. And finally, as I mentioned, we see the Australian stock market as being extremely attractive. Great opportunities for dividend income with some very major companies, particularly the banks, which are paying a gross dividend of around 9%. Pretty good return considering that term deposit's going to give you around 6%. So everyone needs to be patient, stick to their game plan, it'll come good.
On a slightly different front, you're obviously quite passionate about industry standards, given your previous role as chairman of the Financial Planning Association. Can you explain the changes the FPA have made recently and what this will mean for the provision of financial advice in Australia?
I think this is just a groundbreaking change to the Australian financial planning landscape. The Financial Planning Association recently changed its constitution and is now a practitioner-only organisation representing practitioners who have the Certified Financial Planner professional designation and those studying toward that end. It no longer has corporate members. It has introduced a degree-based entry point for its CFP professional program. We've been aiming at this for a long, long time, and the association to take this move now, I think, is just fabulous news for the Australian investing public. Members will also be subject to certain codes of practice and professional ethics and subject to discipline, so that this is a much more robust level than what's being proposed by the government's future of financial advice reforms, and something that I think is very much in the interests of the Australian investing consumer.
John, thank you for your time.
Thanks, Danielle.